Hedges? You want to talk about hedges? Well, tonight we'll do a little bit of hedge talk as well as take a look at the portfolio. So, welcome, traders. It is Tuesday, May 7th, 2024. Markets were up a little bit today. Account was up nicely today as well. So, good overall day in the markets. We'll get into some of the charts. We'll take a look at our accounts. But what I wanted to spend some time today with you is let's talk a little bit about hedges. We did this in our small group training, and I'm going to share a little bit about what we covered in there in our session today. So we spent about 2 hours covering all things hedges, different ways to hedge, different things that you can do. But a couple things that really stand out is numbers or quantity matters. And the more naked puts you have on, okay, the more potential problems you're going to have. So one way of reducing risk, I'm not talking hedging, one way of reducing risk in your account is simply reduce the number of naked puts that you have. If you're trading a 112, how soon can you get those two naked puts to come off? Can you take any of the short puts of the PDS off at some point too? All of these naked puts, the quantities all start to add up, and the quantities all matter. Okay, so you've got to reduce some of that if you want to reduce overall risk. I'm not saying you should trade a 111 or a 1121 or something like that. Either, however you're trading, okay, you've got to try to reduce the sheer number of puts. We've got some trades that use a lot of similar strategies. We've got a 112 trade, which I like better than the 111 simply because I'm a trader and I'm looking for a higher return. Okay, I'm not looking for long-term, buy and not do anything and grow at 1 or 2% a month, or 1.5% a month. That's great for my IRAs. Okay? And in an IRA, I do use a 111 trade. However, my trading account is for trading. Okay, it is not my life savings. It is a trading account, and I want a higher reward. I want 3%. Or more in that account. And because of that, I'm willing to take on more risk. Okay? If you don't want risk and you don't want to, you can't tolerate risk. And a couple weeks ago, when the market went down 6% and everybody freaked out, okay, and the VIX barely even hit 20 for a couple hours in a day and then went right back down to 13 here. If you were freaked out back then, you're trading either too big, okay, or your desire for a better return, it does not match your risk tolerance level. You can't want to grow 3 or 4% a month and then also want to hedge and reduce risk. You can't have both of those. You've got to marry those together. So maybe instead of buying all kinds of hedges and trying to hit 3%, why don't you just try to get to 1.5 to 2% a month and slim down the number of naked puts you're trading. Also, how correlated are your assets? Are you trading ES and NQ and RTY? Well, they're all the same type of correlated underlying. So if one's going down, chances are the others are probably going to go down with it. For me, the largest holding in my accounts right now is oil. It's CL. Okay, so CL is number one, ES is number two, followed by bonds, number three, okay, and then gold, the Aussie dollar, and the euro. So there's where my allocation is spread. So it's pretty well spread out. The nice thing for me is if the markets start dropping, okay, and ES is not even my largest holding, okay, ES is my second largest holding. If the markets start dropping, where are people going to push their money? They're going to push it into potentially gold, safety, okay? They may put it into bonds, safety, okay? Well, gold and bonds are positions that I'm also decently weighted in, right? So I've got a good allocation that if the market starts to go down, I feel I'm in decent shape, okay? But I'm not out here trying to make no money, okay? If you want 1% a month or something like that, just go buy the S&P and just sit there because it's going to make 10, 11% a year, okay? You can do that without trading futures. Why would you trade and try to only earn 1% a month when you know what? You might as well just buy mutual funds, some dividend stocks, or the S&P, and just put it away and leave it there, okay? I'm trading, not investing here. And there's a big difference. For trading, I want to make more money. I'm looking to make 3% a month. I would like to make 30% a year. Okay, so I got to take a little bit more risk on, which means I'll have to hedge a little bit. And when I hedge, there's a couple of different ways to hedge and a couple of different things you want to look at. And understand what you're hedging. When I say hedge what needs to be hedged, am I hedging all my oil positions? Well, no, because they're not campaign laddered trades that I have all kinds of, they're all discretionary trades. I've got strangles, I've got naked puts, I've got potentially ratio spreads, I've got 1-1-2s, I've got just put debit spreads. Okay? I have a variety of trades and they're at different expiration dates, different strategies. I feel I'm pretty diversified. I'm not really worried about hedging oil. Okay, gold, it's in a pretty strong uptrend, but I've got different types of strategies in gold. I'm in bonds. I've got naked puts. I've got longer, naked puts, shorter naked puts. I've got strangles on. I've got 1-1-2 trades on. I've got different different DTA on there. I don't need to hedge my bonds. Okay. Right now, I'm not worried. Okay, it's not a big enough percentage of my account. Neither is ES. Okay, I don't have leaps and naked puts and strangles and 1-1-2s and short-term 1-1. I don't have all of these trades on. Okay, got a handful of them. Okay, but one of the things I think that's been helpful is for ES as when trading futures, it's risky. Okay, you got to understand it. Okay, but when the markets start to drop, when we went down 5, 6, 7% a couple weeks ago and everybody freaked out, okay, well, what actually happened when your buying power rose up and you started to see some red on your screen? Well, it's your newer trades because the naked puts haven't decayed that much and they haven't moved farther away, and your put debit spread hasn't matured at all, so it's going to provide you no help. Okay, if the market goes down earlier in a trade. We know that on a 1-1-2 trade. And if you're going to campaign those trades and you're going to have multiples on and maybe you're laddering, okay, up to 8, which is what I do, and I came up with the long-term 1-1-2 as a really good campaign style trade several years ago. Okay, but there's also, you could just be doing discretionary 1-1-2 trades and putting them on when the time is right and not laddering tons of them on. So even when I'm laddering, and I've got 8 max trades, usually 2 of those trades, the naked puts are already gone. So that means I've only got 6 trades working with naked puts, but I'm not really adding a ton of other naked puts to it. I don't have a bunch of strangles on ES. Okay? I have a 120-day naked put out there and maybe 1 strangle in some accounts, and that's it. Okay? I don't have other 1-1-2 trades on. That I'm doing. I'm using other underlyings for those discretionary trades. So all of my eggs aren't in one basket. But what are you trying to hedge? Okay, I want to hedge against a 10% correction in the market. Are you hedging against a bear market that could be a 20% down move over 6 to 12 months? Or are you hedging a black swan event of 30% that could take 2, 3 weeks, 4 weeks, something like that? 3 different areas to hedge. Not all hedges are going to save you in all of those accounts. What's going to happen more often? And one of the keys here is understanding that typically a bear market, okay, where you're down 20%, that takes 6 to 12 months to work its way through, that happens every 5 to 7 years. Okay? We had one in 2022. Okay? Doesn't mean we can't have one tomorrow, but is that something you're really focused on hedging against? No. Black swan event, that's something that happens every 10 to 20 years. Is that something that I want to hedge against? Not really, not if I'm sized properly. Okay, and I have some help in place as well. Okay, or are you hedging against maybe a 10% correction, 12% correction that could happen over a 3-4 week period, or even a month or 2 period? Well, that's, to me, that happens every 1 to 2 years. A 10% correction, which is a correction to decline of 10% or more, they average 1 to 2 years in between. Okay? And they last maybe a few months, and then the markets will typically recover after that. Your goal is, can you weather the storm on those for a couple weeks or so, long enough to continue to put new trades on, protect the trades that you do have. Well, that's where I want to hedge. I'm not saying that you shouldn't or you can't, okay? But understand, what are you hedging, number one? What are the type of trades that you're having on that you want to hedge against? And then how to hedge those trades. There's a lot of different ways to hedge. You've got long put options. You can just simply buy puts, okay, which to me is my favorite. We'll talk about that. I could sell short calls. Those really don't hedge a whole lot. They'll help generate some income and they'll keep my buying power in check. And again, are you hedging because you're afraid of your buying power going to 100 and you want to hedge your buying power to keep you in the game? That's really part of it for me. Or number two, are you hedging the actual losses that could potentially happen? Okay. Put ratio spreads, there's another one. So you could do back ratio or put ratio spreads. Those aren't bad trades. However, not that valley of death is something that you should be concerned about, because that really is only going to happen when you get closer to expiration. But do they give you enough oomph, okay, to accomplish what you're trying to accomplish? For me, it's hard to figure one out that actually does that without spending a lot of money. And technically, my long put are more effective. Okay, just buying the long put. Okay, it could be volatility hedges. Maybe you want to hedge your volatility. Okay, that would be buying calls or potentially call spreads on VIX, which I've never found to be a good instrument to do. You have to go very wide, like a 20-40 spread, and you have to buy so many contracts and have them on for a while and get lucky enough for VIX to spike up and stay there long enough for you to make any money on it. I find that they're really a waste of money, but you can do those as well. Really, diversification is a way of hedging, which is what I use. So I'd like to diversify as well. And then stop losses are simply another way to diversify your account. So talking hedging with you, do you need to hedge? I don't know. What's your account look like? If you've got all these discretionary trades, and I'm trading some put credit spreads, and I'm trading some ratio spreads, and got some naked puts here, and I've got, butterfly trades or something over here, there's really no reason to hedge for the typical trader. Okay. If you size correctly and you have stop losses in place, there's nothing to hedge. Okay. Stick to your trading rules. Stop out at your stop losses, size your trades to 2% or 1% or 3% or 4% or whatever of your net licks, so that in one trade doesn't really impact you significantly, and you'll be in good shape. If you're putting on longer term campaign trades, I don't know how much trading that really is. Okay? I love the 112 trade. It's been a trade that I've really made my own, and I've come up with some really cool versions of it, I think. Is that really trading? Well, it is, but it's almost investing. You're laddering these trades on, unless you're putting them on in a discretionary fashion of, I got 112s in bonds, I got 112s in oil, I got 112s in ES, I got 112s in gold, I got 112s in copper, I got 112s in RTY or live cattle. Okay, those are discretionary one-off types of trades. Okay, no sense hedging those. Okay, they're one-off trades, size them properly, different underlyings, allocation helps you. But if you're going to ladder a bunch of naked puts on, whether it be laddering a bunch of leaps, laddering a bunch of SPY naked puts or ES naked puts at 60, 90, 120, 180 days, whatever, or you're going to be doing 112 trades at 90, 120, 150 days or whatever you want to do them at. If you're laddering trades and now you've got bunches on, well, now size matters and the number of naked puts matters, and you need to be able to, I think, hedge that a bit. Depending on your style of account, if I'm in a PM account and I have plenty of buying power, and the way I set my larger PM account up, I've got plenty of buying power, I'm okay because I'm trading SPY. I'm okay taking assignment on those. And potentially if I have to, I can wheel back out of it if need be. And I just sell the at the money calls. Okay, I'm not trying to make any money on that, just trying to get back out. I'm willing to take assignment. I don't need to hedge those. Okay? There's no need to hedge something if you're willing to take assignment. So now we're just left with, again, trading futures potentially, or if you have an account where you're using a lot of your buying power and taking an assignment in futures or something is not really an option, now you need to consider a hedge. And for me, my favorite hedge is buying puts. Okay, I love to just buy a put. Okay, it can protect my portfolio against a downside risk in the case of any kind of a market sell-off or the account sell-off. And the closer to the at the money, the more hedge you get, as it intensifies. However, the more quantity you have, because like I said, size matters. The number of nakeds that you have is important when volatility starts to spike. The more naked puts I have, 8, 10, 12 naked puts, okay, as the market's selling off or as volatility is rising, those are going to start to hurt me more than anything else. Okay, it's quantity of naked puts that's going to become a problem. So, in order to combat that, you need to have quantity of long puts. Okay. I know essentially how much I want to spend on hedges. Okay. Do I want to hedge 100% of my portfolio? No. Okay. I'm trading. I'm okay losing some of my money. What I don't want to do is lose it all. Okay. So I want to hedge and offset some of the losses if something bad were to happen. Okay. Not a 5 or 6 or 7% downtrend. I'm talking a 12% or so downtrend in a couple of weeks. Okay, that could be with volatility spiking. That's what I'm more concerned with. I'm not concerned with the black swan hedge. However, I can hedge both with long puts. Okay, so for me, the more quantity of long puts I can put on, okay, I may have to go down lower delta so that I can get more quantity and more bang for my buck. But what you'll see is when you've got 8 puts, if I spent $2,500 for 8 puts, or spent $2,500 for 4 puts, or spent $2,500 on 2 puts, those different levels, the 8 puts will pay off in a volatility spike more than 2 naked puts will at a higher delta. Okay, even at a shallower sell-off, but certainly at the longer sell-off, and certainly when volatility spikes. So I wanted to point those things out from a hedging standpoint, that if you're hedging, understand, what do I need to hedge? Number one, what's the best way to hedge that? And for me, it's quantity of puts, having a handful on. Well, but Tom, you've got to do the black swan hedge because everybody's doing it out there. Well, I'm not doing it, and here's why. Okay, I have the same philosophy. Okay, I'm not against the black swan hedge. This is how I trade it. Okay, in the recent sell-off, many people that had a black swan hedge on saw their buying power skyrocketing. Why? Because they still have short naked puts on. Okay, they're still selling puts so that they can then buy them back and take that money and buy long puts. Okay. Well, here's how I like to look at it. Either way, you're spending money. Okay. So whether I want to sell a $7 put and wait till it gets to $1 so I can buy it back and then go buy more $5 puts or something, okay, I'm still making a trade. I'm still taking on risk because you have to sell the puts to begin with in order to be able to buy them back, in order to take that money and then go buy your long puts. For me, I just go buy the long puts. I skip the middleman. I skip the whole, it's not free. Black Swan Hedge is not free. You have to sell something, buy it back. So you have to make a trade to give you the money to go buy long puts. So for me, instead of buying or selling a $7 put and then waiting 60 days to buy that thing back for $1.50 or whatever the heck it is, okay, why would I not just, and only making $6 on that times 3 tranches, okay, 18 bucks times, what's 18 times 50 multiply, I make $900 and I can buy $900 worth of long puts, okay, out there. You know how fast I can make $900 with a strangle or another trade that comes off in 30 days? I would rather use that money that I'm allocating towards those puts. I'm going to sell a strangle, or I'm going to sell 2 more strangles. And I could sell a strangle in oil. I could sell it in gold. I could sell it in bonds. I could sell strangles in anything I want. I could put a 1-1-2 trade on in any of those. I could sell naked puts in any of those. Either way, I'm just trying to generate as much monthly income as I can, and then I'll still take a percentage of that income and I will pour it back in. Same thing that everyone's doing with the Black Swan hedge. And again, I'm not against it. It's just that I don't like the philosophy of the Black Swan hedge is free. It's not. Okay? You're taking on risk, you're making a trade, and you're selling 3 delta or something naked puts. Okay. I'm not selling three. How long? It takes 60 days. Okay. I would rather put a trade on that takes me 18, 20, 30 days, 32 days, or something like that. That makes me 4 times as much money. And then I'll go take some of that money from all of these winning trades in the time that it takes for you to wait for those 3 puts, okay, to come off in 60 days. I will have made 4 or 5 winners and other things, and probably have made $5 to $6 to $10,000, and then I can take a portion of that and I will go buy long puts as well. I may not go down as low as some people do on it, but I'll buy 8 more puts, and then I'll do that every month. So I've always got like 16 long puts working that are not as low as many, but that's going to give me a hedge. Anyway, hedge what needs to be hedged. Understand what you're hedging. I'm not poo-pooing anything, so don't write me that I don't understand it. And okay, maybe I don't. Okay. I'm only looking at my account and what I'm trying to hedge. And all I'm doing is making sure that I allocate. If your account is all 112 trades in ES, and then you're also trading some naked puts in ES, and that's it, you got to hedge. Okay. Because you've got too many naked puts on and you're too dangerous. Okay. You're going to blow it up. Okay. And in that case, you're going to have to hedge. Black Swan hedge, buying puts, back ratio spreads, whatever you want to do, you got to do something. Okay. One way to combat that is reduce your risk and bring the numbers back. Maybe you need to start closing at 60 days, or I'm sorry, at 80% or 90% instead of 95%. Some people do 95%. I do 95. Some people do 90. Some people do 91. Some people do 87 and 9. Whatever you want to do. Okay. The sooner and quicker you can reduce the number of long puts, the less you have to hedge. Okay? And the less you have to hedge, the better your return could be potentially, but you are impacting your return. Every gimme has a gotcha, per Jim Schultz, and I love that phrase. There is no free hedge. Everything will cost you money. Just find out what works for you. All right, so let's just jump into it. And let's take a look at the account today, and let's move out of the Discord and into the account for the session today. So yesterday, the last 2 days, we had the most perfect delta of all time. We were sitting there at a 1 or 2 delta. We went all the way up to 8 to 68 today. So 68 delta in the account, still 0.01. We are super delta neutral. Again, another way to protect your account without having to hedge is be fairly delta neutral. Okay. If I'm all naked puts, okay, in ES, and that's my whole account is all just a bunch of 112 trades or 111 or any 11 anything, 117s, it doesn't matter. If that's all you are, you're long. Okay. And if the market goes against you, it's going to hurt. Okay. So you have to do something to potentially bring that delta down. I do it with a mixture of trades and a mixture of days to expiration. All right, next thing here is theta. I'm at 1180 in theta, so great theta. Love where I am. In theta, we're 0.24 with a VIX of 13. Okay, VIX is dead once again, super low. We hit another new all-time high today, 491,729. So we are within a whisper, okay, of getting this account to a $500,000 in 4 years. So it's pretty exciting. We're getting there. We got to hit that million, and then that 2 million is our goal coming up. All right, BP usage, we're at 299,033, which puts us at a nice 51% when we take Bill out of the equation. We are right there with our buying power where it needs to be. Now, we did book another $1,038 today to give you a sneak peek of what that looked like. Okay, we closed out a 4,200 naked put. So again, here's one of those naked puts. This one was on ES. I will not be replacing it. in the trade because I want to keep my number and quantity of naked puts down. Okay, but I made $1,000 in 49 days for almost 15% return on capital. Okay, so fantastic return today. So that puts our account up for the year. Realized gains 15.4%, 15.6% on the net lick side. We are averaging 3.65, so 3.7% a year is what we're averaging right now a month. So my goal's 3. I'm averaging 3.7. Okay. Am I taking too much risk on? Potentially. Okay. So I'm letting things kind of unwind a bit and I'm not replacing some. I'm sticking to my plan though. And if you look at my trades and you understand what I have on, okay, it's not all in 112s and ES. In fact, they're sized to less than 50% of my overall buying power. Okay. They generate great money. Okay. And I'm putting them on the right way. But you don't have to worry about it. Okay. If you're sizing correctly, put a little bit of a hedge on, okay, and protect yourself a bit. All right. So where's all of our money going? So far for the month of May, we've got a ZB Strangle for $1,400. Okay. We've got $1,550 in 0 DTE. We've got a 120-day naked put, and then we got a 1,038 spec trade that went on. So we're already for the month up 1% in the first 7 days of the month. So we got, 1/3 done in 1/4 of the time. Okay, the net lick is already up $10,000 for the month already, almost 2%. So we're almost to our net lick goal of 3% a month as well. So we're in good shape. And again, when your delta is this low, okay, you're in pretty good shape. Okay, I'm not so directional that a swing tomorrow could hurt us. All right, so that's what I wanted to leave you with today. I hope this makes sense. New all-time highs in the portfolio. We've got our hedges on, and those hedges pay off in not only a 10% drop, but they will also pay off in a black swan 30% drop as well. They will do just fine there, okay, because they're set up properly. Okay, size matters, but really quantity matters. And I know Uncle Tony from Mexico, and I will be doing another session in the next week or so. And we're going to get a little bit more into that because I know that's a big piece for him too, is quantity or numbers really matter. We're both on the same page with that. You want to keep your quantity down of total naked puts, and how you want to do that, take them off early, mix up your trades, figure out what you want to do. Some of you might go to the 111. I just can't make enough money with it. Okay. And I'm a trader. Okay. I want to make money. I'm not okay with 1% or 1.5% a month. That's great for an IRA. That's great for a long-term investment portfolio. Okay. That's not great for a trader. Okay. I want to trade and make some money, okay, with my trading account. I have other accounts, okay, that I can do a little bit less risky things with and make 1.5%. Okay. We're in it to trade. We're in it to make some money. Okay. Our active trading account's doing fantastic. Another new all-time high in there today. So we're doing fantastic stuff, but we're traders. Okay. I'm not here sitting in a bunker somewhere, trying to earn 1% a month. You can do that without investing or trading. There's no sense trading if that's your goal. Okay. Investing, totally fine. Growing your money, compounding it, that's the secret to wealth right there. I just want to compound my trading accounts quicker. Okay. So I'm willing to take on a little bit more risk here. Hedge what needs to be hedged. Stay safe out there. I hope this was helpful to you. If you like it, give it a thumbs up down there. Certainly help us out in the channel. If you feel the content's valuable, do me the favor and give me the like and the thumbs up down there. You can drop comments in if you would like. I'll try to respond to as many as I can. I get a lot. I can't get to them all. Okay, but do the best. If you're asking me for trading advice, come join us in the Discord, okay, and get into a community where you can learn to trade. Okay, if you're asking a stranger, me, for advice, okay, you don't have a plan. Okay, come and learn how to put together a plan. Come to learn how to invest. Okay, and let's see what we can do to help you guys out. All right, we'll see you later. Stay safe. Bye-bye.